Hi there. Today we dig into CME, the heart of the global futures market. Why should U.S. or global investor care? Simple. Bitcoin, U.S. stocks, crude oil, the assets that move your 401k, your brokerage account, and the headlines you wake up to, are priced and hedged here around the clock. Why do futures get force liquidated? If expiration hits, do I really take delivery of stuff? Why can losses hit my cash balance so fast? In CME rules. Trading hours, expiration, and settlement. Nail those three, and the mechanics behind global news moves become clear. The E-mini S&P 500 chart on screen comes from CME Group, the world's largest futures exchange. Under the CME umbrella, NYMEX handles crude and metals, and COMEX handles precious metals like gold, silver, and copper. They all follow the same CME rulebook. Key difference: equity and index futures like this E-mini S&P 500 settle in cash. P&L hits your account as dollars, like a paycheck direct deposit, not a truckload of shares. Crude oil futures are the opposite. Hold to expiration, and you can be on the hook for real barrels, storage, freight, and insurance included. Retail traders must exit before expiration. Look at the E-mini Nasdaq chart. It looks like round-the-clock trading, but it is not. The exchange closes every Friday at 4 p.m. Eastern and reopens Sunday at 5 p.m. Eastern. That is about an 18-hour weekly shutdown. If you're in the U.S., that window is simply your weekend. If you're overseas, convert from Eastern. London, Tokyo, Sydney, and Dubai clocks all land somewhere inside that close stretch. Holding a stock or index futures position into Friday night means you ride Saturday with no liquid tape. News can still break in those 18 hours. An emergency Fed statement, a geopolitical shock, a corporate bankruptcy. Monday's reopen can print a totally different price. That is gap risk. Without enough spare cash, a margin call can wipe several months of paycheck in one reopen. 루게또 S&P 500 퓨처즈 차트. Always check the contract month. ES expires on the third Friday of March, June, September, and December. Unlike many U.S. equity options that expire monthly, or even weekly, CME equity index futures run on a quarterly cycle. Precise terms: the front month is the contract trading now. The next month, or back month, is the following quarterly expiry. To keep a long horizon position alive, you roll about every 3 months. Example: sell the March contract as expiry nears and buy the June contract. That is sell front / buy next. That roll creates a roll spread cost, the price gap between front and next. If crude is in contango, future price above spot, every rollover bleeds dollars. The important part: this cost does not show as a neat line on the chart, yet it eats long-held positions. Stack several rolls, and the cumulative drag can be material. The gold futures on screen, GC1, are cash settled. At expiry, P&L is calculated in dollars and credited or debited to your account. Done. No need to store gold bars in a vault. Think of it like a paycheck. You get cash, not the company building. E-mini S&P 500, E-mini 나스닥, 엔드 골드 퓨처즈 더 CME 메인스트림 컨트랙트 올 워크 디스의. Crude oil is the opposite. Hold past expiry, and you may have to take or make delivery of real barrels, tank storage, freight, and insurance on your dime. A retail trader cannot take oil delivery, so you must sell before expiry. Miss it, and the system force closes you, often into tiny volume, with brutal slippage that can cost hundreds or thousands of dollars in one print. The S&P 500 on screen looks like a normal day, but expiry week is a different game. It is the most dangerous week on the futures calendar. Hedge funds, pensions, and large traders worldwide unwind at once. Volume can jump to roughly 3 to 5 times a normal week, like every player at the table folding their cards at the same second. Gamma explosion means hedging flows from options that slam the tape with sudden buy or sell pressure. Price levels that looked quiet can whip hard. Stops trigger more stops. Liquidations trigger more liquidations. Speed goes vertical. A normal day's range can compress into a few hours. Even with spare cash, a poorly placed stop can still get you stopped out. From 2 weeks before expiry, sizing down is the prudent play. Rule 1. Treat Friday afternoon Eastern positions with care. After the 4 p.m. Eastern CME close, the weekend tape is shut. You are carrying holiday and weekend news risk for free. Rule 2. Liquidity drains starting about 2 weeks before expiry. Dumping a large size into a thin book snowballs slippage, like watching a $3 coffee jump toward $4.50 on every fill. Rule 3. Physically delivered contracts like crude must be sold before expiry. Miss it and the auto liquidation hits when volume is nearly gone. Unexpected dollar damage. Recap. This lesson is educational, not investment advice. Futures leverage means losses can reach your cash balance fast. Keep spare capital and write a stop plan before every trade.